Another day, another story. Welcome to our video on managing a company's current assets and liabilities to ensure cash flow. As a business owner or manager, it is important to have a solid understanding of your company's financial health, especially when it comes to short-term obligations. Let us discuss how to manage current assets and liabilities to ensure your company has enough cash and other liquid resources to meet its short-term obligations. Current assets are resources that can be converted into cash or used to pay off short-term obligations within a year or less. Examples of current assets include cash and cash equivalents, accounts receivable, inventory, and prepaid expenses. On the other hand, current liabilities are debts and obligations that are due within a year or less. Examples of current liabilities include accounts payable, short-term loans, and taxes payable. Managing current assets and liabilities is crucial because it helps ensure that a company has enough cash and other liquid resources to meet its short-term obligations. If a company doesn't have enough cash to pay its bills, it may have to borrow money, which can be expensive and increase the risk of default. Here are some strategies for managing current assets and liabilities. Analyze your cash flow. Understanding your company's cash flow is essential. A cash flow statement can help you identify the sources and uses of cash in your business. This can help you predict potential cash shortages and take corrective action before they occur. Optimize inventory. Inventory is a current asset that can tie up a lot of cash. By optimizing inventory levels, we can reduce the amount of cash tied up in inventory and free up resources for other purposes. For example, by implementing just-in-time (JIT) inventory management, which involves ordering inventory only when it is needed. Negotiate payment terms. Negotiating favorable payment terms with suppliers and customers can help improve your company's cash flow. For example, you can negotiate longer payment terms with suppliers to delay cash outflows, or offer discounts to customers who pay early to accelerate cash inflows. Monitor your accounts receivable. Accounts receivable is a current asset that can also tie up a lot of cash. We can improve our company's cash flow by monitoring accounts receivable and taking steps to collect outstanding balances. This can include offering early payment discounts, sending reminders, or even using a collection agency for delinquent accounts. Use short-term financing. If we need to bridge a cash flow gap, short-term financing options such as lines of credit, factoring, or invoice financing can be helpful. However, it's important to use these options judiciously and not rely on them as a long-term solution. Managing current assets and liabilities is critical to ensure that company has enough cash and other liquid resources to meet its short-term obligations. By analyzing our cash flow, optimizing inventory, negotiate payment terms, monitor accounts receivable, and use short-term financing when necessary, this can improve our company's financial health and reduce the risk of cash flow problems. Thanks for watching.